In the summer of 2018, the most valuable financial company in Germany was not Deutsche Bank. It was a payments processor headquartered above a suburban office park outside Munich, worth 19.4 billion euros, admitted that September into the DAX, the index of Germany's 30 most important companies. Its accounts said it held nearly 2 billion euros in cash in escrow on the other side of the world. The two banks in Manila that supposedly held that money had never seen it. The documents were fakes. Almost a quarter of the company's balance sheet did not exist. And when journalists said the numbers did not add up, Germany's financial regulator did something extraordinary. It did not investigate the company. It went after the journalists. Welcome to Billion-Dollar Autopsy. This is Case File 8, Wirecard. The money that never existed. Wirecard began in 1999 in Aschheim, a quiet suburb east of Munich. Its first business was processing card payments for merchants the big banks would not touch, gambling sites, adult entertainment, unglamorous money. But processing payments is a toll booth. You take a sliver of every transaction, and the internet was about to multiply transactions beyond counting. Under Chief Executive Markus Braun, an Austrian who wore black turtlenecks and spoke of Wirecard as a technology company that happened to move money, the firm rebranded itself as Germany's fintech champion. The story was irresistible. While Germany's old banks shrank, here was a homegrown digital winner, growing through every quarter, expanding across Asia, reporting profits year after year. Politicians praised it. Analysts raised their targets. By August 2018, the market valued Wirecard at 19.4 billion euros, more than Deutsche Bank, the country's largest lender. A month later, it entered the DAX. Germany finally had its answer to Silicon Valley, at least on paper. To understand what went wrong, you need to understand where the profits supposedly came from. When you tap a card, a licensed company has to move that money from your bank to the merchants. Wirecard held those licenses in Europe. But in much of Asia and the Middle East, it did not. There, Wirecard said partner companies, so-called third-party acquirers, processed payments on its behalf and shared the profits. And what profits they were. This partner business, run through firms in Dubai, Manila, and Singapore, was reported as the most profitable part of the entire group for some years, the majority of its earnings. Think of a restaurant chain that reports most of its profit from franchise kitchens no inspector has ever visited. The dining rooms you can see are ordinary. The magic is always somewhere else. Wirecard's magic was a cash register that rang up record sales in countries where nobody could find the drawer. One more piece of machinery matters here. The profits from those partners were said to accumulate in escrow accounts, holding accounts controlled by a trustee, sitting at banks in the Philippines. Money in escrow is money you claim but cannot spend yet, which makes it for an auditor the hardest kind of money to disprove, and for a fraud, the easiest kind to invent. Numbers that could attract two kinds of attention: investors and people who check. At the Financial Times in London, a reporter named Dan McCrum started pulling threads as early as 2015 in a series bluntly titled House of Wirecard. In 2016, an anonymous short-seller dossier accused the company of money laundering and inflated accounts. Each time, the response was the same. Wirecard cried market manipulation. It hired lawyers and investigators. The stock dipped, then climbed higher, because standing behind every denial was something no blogger could match. The signature of EY, one of the world's big four accounting firms, which audited Wirecard's books year after year, and for a decade found them clean. If you doubted Wirecard, you were not just doubting a company, you were doubting the referee's scorecard. And the scorecard said, champion. Wirecard did not just argue with its doubters, it watched them. Years later, reporting and court filings would reveal that critics of the company, short sellers, journalists, analysts, had been followed, photographed, and surveilled by private operatives, and some were targeted with hacking attempts and sting operations designed to discredit them. Dan McCrum has described working on the story from a windowless safe room on computers kept off the network because the FT assumed, correctly, that someone was trying to get IA inside. Hold on to this pattern, a payments company from a Munich suburb running intelligence-style operations against the people checking its numbers. It will matter later, when we meet the man who ran much of the operation. For now, keep the question every fraud eventually answers. How far will they go to stop one number from being checked? In January 2019, the Financial Times published something harder to dismiss, allegations from inside the company. A whistleblower in Wirecard's Singapore office described forged contracts and suspect bookkeeping used to inflate numbers across Asia. Weeks later, police raided the Singapore offices. The stock fell hard. For the first time, the question was not being asked by short sellers with a financial interest, but by documents from Wirecard's own building. Germany's regulator now faced a choice that would define this entire case. In front of it, a DAX company accused from the inside of forging its business. Would it investigate the company or the people exposing it? It chose the company. In February 2019, BaFin, Germany's financial watchdog, its equivalent of America's SEC, banned investors from placing new bets against Wirecard stock for 2 months. Nothing like it had ever been done for a single German company. The official reasoning, the attacks threatened confidence in Germany's markets. Read that again. The reporting was treated as the threat, not the thing being reported. Then it went further. Criminal complaints were filed against the Financial Times journalists themselves on suspicion of market manipulation. The message to every doubter, every analyst, every auditor was unmistakable. The German state stands behind this company. The referee had not just missed the foul. He was now tackling the man pointing at it. With the state's shield raised, the believers doubled down. In April 2019, Japan's SoftBank agreed to invest 900 million euros. The stock recovered. That October, the Financial Times published internal accounting documents suggesting profits at units in Dubai and Dublin had been inflated. Wirecard's answer this time was confidence itself. It hired a second Big Four firm, KPMG, to conduct a special audit and settle every question. As Braun put it, once and for all, it was meant to be the exoneration. It became the fuse. KPMG spent 6 months inside Wirecard. On April the 28th, 2020, its report landed, and it did not exonerate anyone. On the very deals that generated the heart of Wirecard's profits, the third-party acquiring business, KPMG said it could not verify the numbers. Not that they were wrong, that they could not be verified at all. Documents were missing. Partners would not cooperate. Data arrived late or never. An auditor invited in by the company itself given every key, and it still could not find the business. Braun declared victory anyway. No proof of manipulation, he said. But now there was a date on the calendar that could not be spun. June the 18th, the day EY had to either sign the 2019 accounts or refuse. What follows is the fastest collapse of a blue-chip company in German history. Thursday, June the 18th, 2020, EY refuses to sign. After a decade of clean opinions, the auditor says it cannot confirm 1.9 billion euros, roughly a quarter of the balance sheet, supposedly sitting in escrow accounts. The Philippines, held through a Manila trustee. The stock collapses. Friday, June the 19th, the 2 Philippine banks named in the documents, BDO and the Bank of the Philippine Islands, say the account confirmations are bogus. The money is not missing from their vaults. It was never in them. Markus Braun resigns. Monday, June the 22nd, Wirecard concedes in its own official statement that the 1.9 billion euros in all likelihood do not exist. That evening, Braun is arrested in Munich. Thursday, June the 25th, Wirecard files for insolvency, the first company in the history of the DAX to collapse into bankruptcy, owing its creditors almost 4 billion $. From first refusal to corporate death. 1 week. So where did 1.9 billion euros go? The prevailing answer from investigators and the insolvency administrator is the emptiest sentence in corporate fraud: nowhere. It never existed. For years, the third-party partner business had reported profits that in large part were invented. But invented profits create a bookkeeping problem. Fake earnings must show up somewhere as fake assets. The escrow accounts were the answer. A pile of cash conveniently parked far away, vouched for by paperwork, in accounts almost nobody ever checked. The profits were fiction, so the cash had to be fiction too, one lie balancing the other in perfect double entry. That is the phantom ledger. Wirecard did not lose the money in a bad quarter or a rogue trade. It manufactured the money on paper because paper was the only place the business had ever been. The autopsy of the institutions took longer. Germany's parliament convened an inquiry into how every safeguard had failed at once. EY, which had signed off on Wirecard for a decade, faced Germany's auditor oversight body, a PAS. In April 2023, it was fined €500,000 and barred for 2 years from taking on new audits of companies of public interest. A rounding error in money, in reputation, a branding iron. The civil courts moved too. Former board members have been held liable for €140 million in damages to the company's own insolvency estate. And BaFin, the regulator that had banned the bets and pursued the journalists, was left explaining to Parliament why it had aimed its powers at the men holding the flashlight, instead of the men holding the books, and the bill for all that belief was paid by the believers. Wirecard had been a DAX company, which means every index fund tracking Germany's benchmark held its shares automatically inside pension accounts and savings plans that never choose. Tens of thousands of retail investors, many of them ordinary Germans proud of their homegrown champion, were left holding paper worth almost nothing and holding it in many cases. Precisely because the institutions had told them it was safe to. As for Markus Braun, his criminal trial opened in Munich in December 2022, in a courtroom built beneath a prison, fitting, because by then Braun had already spent 2.5 years in custody, and he has remained there through the entire proceeding. Prosecutors charge him and 2 co-defendants with commercial gang fraud, alleging that falsified accounts conned lending banks out of €3.1 billion. The proceedings have become the largest fraud trial in post-war German history, more than 230 trial days, more than 200 witnesses. Braun denies it all. His defense is, in its way, the most Wirecard argument possible. He says he was deceived too, a victim of the very fraud he presided over, run past him by others. A verdict is expected this year, 2026, 6 years after the collapse. German justice is thorough, it is not fast. But the strangest chapter belongs to the man who actually ran the third-party business, Chief Operating Officer Jan Marsalek. On the day EY refused to sign, Marsalek was fired. He told colleagues he was flying to Manila to track down the money and clear his name. Investigative reporters later established that the Manila arrival records were doctored. He was never on that plane. Instead, he flew from a small Austrian airfield to Minsk and crossed into Russia. For years, silence. Then the story returned larger. In March 2025, at the Old Bailey in London, members of a Bulgarian spy cell were convicted of running surveillance operations across Europe for Russian intelligence. Prosecutors told the court the cell's ringleader took his instructions from Jan Marsalek. And in September 2025, a joint investigation by Der Spiegel, ZDF, the Insider and PBS Frontline reported that Marsalek lives in Moscow under a false identity, Alexander Neladov, protected by and working with Russian security services. He remains on Interpol's wanted list. The man who invented a phantom business now runs a phantom life, and this time the accounts really are unverifiable. Here is what this autopsy finds. Wirecard was not a fraud that fooled the system. Wirecard was a fraud the system defended. The auditor signed for a decade. The regulator silenced the doubters. The index anointed it. The politicians celebrated it. Every institution paid to be skeptical chose instead to believe because the story was national and flattering and rising. The evidence was available the whole time. Reporters found it with phone calls and patience, registered addresses that led nowhere, partners that did not process, a drawer that was always empty. 1.9 billion euros did not vanish in June 2020. It had been absent for years, glowing on the balance sheet like a light with no bulb. The collapse only began the moment one institution finally did its job and refused to sign. The Munich verdict will close the file on the men. It will not close the question the case leaves behind. How many balance sheets right now are glowing with money nobody has ever actually seen? If you enjoyed this autopsy, like the video, subscribe for the next case file, and share it with someone who would find it interesting. The case files stay open. Every fortune leaves evidence.